everybody, it's the Charlton Advantage team here, and we're here with one of our favorite mortgage brokers, Sean Vanzante of Customized Lending Solutions. It's a local mortgage brokerage here in town, and one of the reasons we love using Sean is because he's a lot like us in the sense that he loves to educate people on what's going on. And so we're here today so that he can give us a little bit of insight and help you understand some of the burning questions that you have regarding what's going on with mortgage rates. Okay, so thanks very much, Sean, for coming.
Well, thank you for that great intro, and thanks for the invite. It's a pleasure to speak with you guys and your clientele as well. There's been a lot of changes in the last few years in the mortgage industry. It seems we're getting a new change every quarter, and sometimes we lose sight of what's going on in the interest rate world and forget to speak about that. So, and you guys are one of my favorite real estate brokerages.
Awesome. Thank you. That's great. So, Semone, can you tell us what some of your clients are asking?
Yes, so can you just help everyone understand what the interest rate increase means for buyers?
Sure. I jotted down a few stats to kind of put things in perspective over the last few years. So in 2010, September, prime rate was 3%. It stayed that way for a little bit more than 4 years and didn't change until January 2015. It's a pretty long run at the same interest rates. And in January 2015, it went down to 2.85. Fast forward a little bit, a few fluctuations, nothing too major. And here we are in the last couple of months, in July and in September, we saw a quarter-point increase each time. So prime is now at 3.2, which isn't much different than 2010. But the reality is payments have gone up now. Interest rates go up, your payments go up. It's approximately $15 per month extra per $100,000 mortgage for each 0.25% increase in prime. So prime has gone up twice, it's gone up by 0.5%. So consumers' payments have gone up approximately $30 per $100,000 of mortgage. Bottom line, your payments go up because you're paying more interest. The money's got to come from somewhere. It comes from spending money on other things that you like to spend money on.
So does it make sense to lock in or to go with a fixed or a variable?
So people who are looking at that decision now are usually people who've recently purchased a home, people who are renewing their mortgage, or maybe they have to refinance. And they're asking themselves the same question that's been asked for decades. Is it better to go fixed or variable? The reality is variable rates have gone up 0.5%, but fixed rates have actually come up a little bit more than 0.5% since just before the July long weekend. So fixed rates have gone up, variable rates have gone up. Variable rates are still an attractive option depending on what you're looking for. If you're looking for a lower payment, you're looking to pay less interest, and you have some risk tolerance to payments going up, variable rates are still a very attractive option. They have gone up, it has gotten more expensive. Fixed rates have gone up and it's gotten more expensive, but variable rates are still anywhere from 0.3 to 0.6% cheaper than a fixed rate option. So about $500 per $100,000 mortgage is the difference if your variable rate is 0.5% cheaper than your fixed rate. Still very attractive.
Yeah.
Sean, one of the questions that I'm getting are from current homeowners who have a variable rate, and they're wondering if they should be considering, if at all, moving to a fixed rate.
Right. Great question. When interest rates start to rise such as this, our phones ring off the hook with the same question over and over again. It's really an individual decision people have to make, and it comes down to how much more has your payment come up? Is it still affordable for you? Variable rate mortgages are definitely more expensive now than they were a few months ago. But fixed rate mortgages are also more expensive. So although your variable rate payment has come up, if you convert into a fixed rate, your payment's going to be even higher because the fixed rates are higher than the variable rates. So you're going to be paying even more than the increase in prime anyways. So you kind of have to measure that benefit. I usually ask consumers, what made you choose a variable rate in the first place, be it a year ago, 2 years ago, or 3 years ago? And most people, it's because there was a lower interest rate. They saw an opportunity to pay more in principal, and they definitely had a lower payment. That's still true today. It's more expensive than it was a few years ago, but it still is true that variable rate is cheaper than fixed rate. I would suggest to consumers, they really need to look at how much your payment has increased, where are you going to get that money from to pay that increase, and how does it affect you? And how much more can you withstand? If prime rate goes up another 0.25% or 1%, what's it going to do to your own budget? If people don't know how to do that or they don't have a budget in place, they should be contacting a mortgage professional such as us, and we'll be more than happy to do that with them.
That's great. Thank you so much.
And you know what, Sean, that's one of the things that I think all of us love about you is that you're really able to coach our clients to make the right decisions for them. So thank you again for coming out today. If you'd like to get in touch with Sean, we'll put his contact information here. And if you're interested in knowing the value of your home or looking for the next move, just give our team a call. We'll make sure you're in great hands.
Good close.
I
know.
That was
Very
very
good.
close.
Yeah,
you did
that.
Wow. And then you need to invite the camera.
Please,
Current homeowners who have a variable weight.
It's okay.
See.
I have a variable weight.